Alright, so here we'll be looking at a slightly more in-depth version of what we covered during the bootcamp, and this will be kind of going through a more in-depth version of the refined analysis. So this is part one, where we're looking at what the R stands for in refined analysis. So the R in refined analysis, as we all know, already stands for return on equity, and the exact definition of return on equity is that it measures the corporation's profitability by revealing how much profit a company generates with the money the shareholders have invested, and it is calculated by the net income over the shareholders' equity. So what does net income and shareholders' equity mean? So first, shareholders' equity is basically calculated with all the net worth of a business. So all the value of the stocks together. Here, take this example where you and four other people all invest $10 per share into a company. That basically means that the total equity of the company, or the shareholders' equity of the company, will be $50. So return on equity will be calculated once again as net income over shareholders' equity. So let's say out of the $50 that they spent, out of the $50 that you gave them, they were able to make $20 of net profit from those $50. So from this, you can calculate that the shareholders' equity, the net income divided by shareholders' equity as a percentage. Here we can see the return on equity would be considered 40%, and that is good over the 15% of what we really wanted it to be. So here we can see that 40% is a very good return on equity. So here we can check either the shareholders' equity by measuring the free cash flow or doing a little more research and finding the actual shareholders' equity. So here we can see the shareholders' equity of McDonald's, or no, this is Google, is 201,442 million. So that equals to $201 billion. So here we have the shareholders' equity of $201 billion and the net income of $34 billion. So you just divide that and then you get a return on equity of 17%. And once again, the return on equity basically shows whether the business is retaining profits and making good use of the equity that you give them. And it basically gives them how well they're using their money and whether they're using the money to like an acceptable standard, of which we defined as 15%. And this is known as return on equity. And it is essentially the percentage of returns that they or the profit they're making with the money they receive. And we want to find companies that make consistently 15% year on year. So just an example. So let's say company A makes $10 from the $100 of equity that they're given, and company B makes $20 with the $100 of equity they're given. We can see company A has a return on equity of 10%, and company B has a return on equity of 20%. So we can see that company B is making a better use of their money because they have a higher return on equity. And return on equity greater than 15% is good, and the higher the return on equity, the better. So that's kind of a more in-depth analysis about what return on equity is and kind of what it means and how it's calculated.